Hello, fellow Rebel Capitals. Hope you're well. So, interest rates are tanking down big today, which is very weird because we got the CPI report yesterday. So, I want to go over the CPI report right now because I didn't have time to do that yesterday. I want to talk about what's happening with interest rates and gold and other assets. And I want to try to connect some dots here throughout this video. So, let's start first and foremost by going over what is happening with the very important, let me adjust my camera here, the very important 10-year treasury yield. Boom, let's go over there. Hopefully got the screen share working. And we just gone straight down since the open. I mean, we opened up here, we're down almost 6 basis points, which doesn't seem like a lot, but you guys know from watching my videos, that's a pretty big move in the 10-year. Now, the other day when we got the non-farm payroll out, it was down 20 basis points, which is crazy. But the 2-year was down even more than that. 2 years down 25 basis points. We had a massive, massive, massive bull steepener. And the question becomes, what does that bull steepener tell you? What message are interest rates sending you, the investor, right now about the health, or lack thereof, of the underlying economy and growth and inflation expectations? Because you guys know well, you're sophisticated rebel capitalists. You know that unfortunately, the interest rates along into the curve aren't so much about supply expectations, but more so about growth and inflation expectations. So what we're seeing right here in the 10-year treasury today would tell me growth and inflation expectations are coming straight down. And let's go over to the 2-year, because the argument that you get long into the curve is, well, it's all about issuance. Well, Scott Bessent just isn't issuing any 10-year treasury yields. Okay, I don't buy that, or I don't buy that argument. I think it's a weak argument. But in that case, then you would expect those yields to be flat, let's say, or going down. But then you would expect the 2-year treasury to not be going down as much, if not going up, right? Because there's not an issuance issue at the when you get closer to the front end of the curve. But look at the 2-year. 2 years down 5 today. But if we look at the 2-year, 10-year spread, which I have somewhere here, this is why I keep all these tabs open. All righty. So I need to refresh. And we are 57 basis points. Okay. I guess I could have done the math there in my head, but I barely graduated high school. As most of you know, I almost flunked out. So the math stuff isn't my strong suit, but I can read, believe it or not. And I can read that this is 57 basis points, the spread, and that is increasing. So what this tells you, can I actually, let me try to zoom in to just the last month. I think that would be interesting. Let's go to 2025, and then let's go to 7. Okay, there you go. This is what I'm talking about right here, guys. And the other day, fortunately, I increased my position right when it, in fact, this is not intraday, because intraday it got down to 40. And as you guys know, I've got a position on with futures. I'm not going to get into it. I talk about it, Rebel Capitalist Pro, but it's kind of like a spread trade where I go long the 2-year and short the 10-year. And so I'm trying to make money if the spread between the two increases. And this has worked out very, very well, as you can see. But this is really a result of what's happened over the past 2 days. Just this, interest rates have gone down, but the spread has increased between the 10-year and the 2-year. And it's increased as a result of the 2-year going down faster than the 10-year. Because keep in mind, this spread could increase by the 10-year going up faster than the 2-year. That would be a bear steepener. But this is the bull steepener. And what that bull steepener tells us about growth and inflation expectations is that they're going down. They're going down. And therefore, you would expect the odds of the Federal Reserve cutting interest rates to go up. So if we go over to the CME group, which I just whiffed on, I did not mean to go to GDP now. Forget although that might be interesting. What are expectations for GDP growth here? 2.5. 2.5 after the non-farm payroll. Okay, I'll take the under on that one, but but let's go over to where I was trying the website I was trying to check out, the CME Group, because this is Fed Watch, and as you would expect, by looking at the move in the 10-year Treasury and the 2-year Treasury with that bull steepener we talked about, you would expect the odds of the Fed cutting rates in 35 days to be very, very high. And yes, they are very, very high. In fact, they're almost 100%. Now, what's really, I think, the big news looking at this report or these data is simply the pause. The pause just one day ago was 6.1%. And the cut by 25 was 93.9. The 50 basis point cut was 0, but now it's a 0.1. And I'm not saying that my base case is they cut 50, but I think it's way higher than 0.1. Way higher. I would give it, if I had to guess, assuming we don't have any catastrophic data come out, which we most likely won't because Trump has fired everyone that could give us any type of bad news. We'll keep that topic for a separate video. Assuming it stays where it is right now, I would say 10%. 10% 50, 90% 25. So again, not my base case, but 0.1%, I think that's extremely low, especially when you're looking at the action in the 10-year and the 2-year. Okay, now, and by the way, the dollar, I think, is pricing this in as well. So if we look at the DXY, just using that as a broad proxy here, 97, so under 98. And I think this is just all about interest rate differentials. So if you guys know from watching my videos that over long periods of time, I don't know that the interest rate differentials matter that much. I think it's more about the mechanics and the structure of the global monetary system. But over a 1 month, 3 month, 6 month period, interest rate differentials absolutely impact the dollar versus other currencies. And in this case, the DXY, mostly euro. So this move down does not surprise me. And this just tells me that the market is expecting the Fed to drop rates more than they were, back here. I think all this move down is just strictly interest rate differentials. And that matches up with the moves that we're seeing in the interest rates. And then, of course, the probabilities there with the CME Group. So now let's go over to the CPI. This came out yesterday. And the punchline here, month over month, is right at expectations. So 0.2, let's go down here, 0.2. Let me zoom in for you guys. I know sometimes it's hard to see these charts if you're watching this on a phone. So 0.2 was the number, but what I like to focus on more so is the month over month and kind of seeing the trend. And then we also have to look at base effects. So what we lost was a 0.1. What we gained is a 0.2, which is why the CPI, did we stay the same? We probably, and they round it as well. So it's not just perfect math, but all items. And I wish this was a interactive chart. That's annoying. So we're at 2.7. And let me just go over here really quick because this will give us the expectations. We had expectations at 0.2. We got a 0.2. We had expectations year over year at 2.8. We got a 2.7. So that's just kind of the rounding. And because obviously that would have included the base effect. And then core, we were right on the nose at 3.1, but up from the previous month, year over year. Okay, so now let's go back to the report. And by the way, Zero Hedge made a great point that I hadn't even thought about. And obviously, Trump fired the gal that was in charge of the BLS because he didn't like the data that she was giving for the labor market. And I think the more I've thought about that, the more it's my belief she was not doing it for political reasons. The reason I say that is because she did the exact same thing. So what she was doing under Biden was she was juicing the headline number and then revising the numbers down after the fact. She was doing that with Biden, but she was doing that the exact same thing with Trump. She was juicing the headline number and then revising the numbers down afterwards. So I don't know. For me, that's an argument that she's incompetent or the methodology is bad. It's not really an argument for the political stuff. But anyway, the bottom line is whether you think whatever you think about this whole situation, the bottom line is there's going to be incentive for the new guy, for the guy from the Heritage Foundation coming in and making the numbers look a little bit more, let's just say, optimistic. It is what it is. That's politics, right? But what I didn't realize that Zero Hedge pointed out is the guy is in charge of the BLS. So it's not just the labor data, it's the CPI as well. Now, I'm not saying that he had a lot to do with this, 'cause I think he was just hired. But moving forward, we've just got to ask that question. We just, you can say it's right, wrong, whatever. But as astute investors, you've got to set politics aside because we're talking about your portfolio here and we're talking about probabilities, and you can't let emotion filter or we can't let emotion really dictate our decision making process. We can't even factor that into our analysis. Okay. So anyway, getting back to that, I just thought that was interesting. That's something I hadn't thought of, that the guy's going to be in charge of the CPI, not just the non-farm payrolls. Okay. So I think one of the main reasons why interest rates came down to the degree to which they did yesterday, and we're seeing that continue today, is the market has been expecting tariffs to increase prices substantially. So what we can see month over month is we really haven't got that. And you could say, oh, there's a big lag effect with the tariffs and whatnot. I mean, maybe, but I don't know. It's not really looking like they're having a huge impact. And I think this is for a couple reasons. Now, we're going to dive into the details of what prices are going up, what prices are going down. But I think just broad strokes, the reason we haven't seen big price increases is twofold. Number one, when you look at a basket of goods and services, even if prices are going up over here, incomes aren't going up to a degree to which they would be able to afford the stuff over here and the stuff over here. So if incomes aren't going up to the same level at the same rate, then they're robbing Peter to pay Paul. We talk about that on this channel all the time. So they're taking aggregate demand away from here to allocate it to here with the price is going up. And therefore, these prices might go up, but basket of goods, it's kind of a wash because these prices possibly could be going down, or at least disinflation. Also, I think one of the main reasons we're not seeing the producers increase their prices to a large degree. So we're not seeing the consumers have to eat these costs to a large degree. Now, obviously, for some items, they are. There's no getting around that. But when you look at the macro, it's not obvious that the consumer is actually having to pay these prices. And, good on Trump. Good on Trump. That was his prediction. And so far, it's coming to fruition. But the reason why, in my view, is because I don't know that these producers can increase their prices without just massively impacting demand. So I think it's much different when you're in a weakening economy versus an economy that's running on all 8 cylinders, in which case you probably would have seen more of the pass through to the actual consumer. Another thing, if I'm a producer in China or Japan or whatever, and I'm looking at these tariffs, I'm going to eat as much as I possibly can at the beginning because I don't know how long these tariffs are going to be here. Love Trump, like him, hate him, whatever, it doesn't matter. The bottom line is things change very, very quickly. That's kind of his MO. So if I'm Toyota, I'm like, okay, I'm going to try to eat some of this margin or eat some of these costs, reduce my margin, just to try to get by the next 2 or 3 months so I don't lose market share. Because in 3 months, the tariff landscape can be completely different. So I think that's a lot of what we're seeing here. But then going into the base effects, if we continue with this point two over the next few months, you can see that we've got other point two. So we're going to have no real base effects over the next 3 months. But once we start getting into Q3 or Q4, excuse me, then you're going to see some massive base effects hit the overall CPI, which again doesn't really matter for you guys as far as the prices that you're paying at the grocery store, but it matters for what the Fed is doing and therefore how asset prices are impacted and what that means for your portfolio. The bottom, at the end of the day, that's what we're trying to figure out here. So if we add a 0.2 when we're losing a 0.3, obviously CPI comes down. Let's just say by a tenth of a percent. But then if we go to 4, we have a 2. Now we're down by 0.2, 0.5. Now we're down by 3, right? So assuming that we have a 0.2 here, just with the base effects, that takes us down to almost 2%, maybe 2.1, depending on how they're rounded. So this is, I think that's why the treasury market, the yields have gone down to the degree to which they have. And they will probably continue to go down. At least that'll be the trend, because what the market was really worried about in terms of inflation looks like it's not playing out, and it's not going to play out. And then you combine that with the non-farm payrolls and the revisions, and the market's like, okay, growth and inflation expectations were here. Now, when you combine the lack of growth due to the labor market and the lack of inflation due to the tariffs not really panning out, then that takes growth and inflation down to this level. The prices or the yields have to adjust, as well as the probabilities of the Fed rate cut. Because the Fed, if you take them at their word, their dual mandate is you've got labor market over here, unemployment, and you have inflation over here. So what should they prioritize? And they have been just prioritizing inflation, pausing, keeping rates the same. But now the market is predicting, all things considered, that they're going to start prioritizing the labor market, and that means, or unemployment, and that means a higher probability that they're going to drop and drop faster, especially when you consider the rhetoric coming out of the Fed, and the Fed governors are becoming more and more dovish. All right, let's get into the details of what prices went up, what prices went down. Now, I know the CPI, it's the CP lie, as my buddy Jason Burrick says, and that's totally true. And is inflation higher than 2.7? I would say absolutely it is. But we have to look at this stuff because this is how the market trades. This is the market, and this is we have to look at the actual inputs the Fed's using for their decision-making process. At the end of the day, it's not about what you think, it's about what the market thinks. So that's why we really got to pay attention to this stuff, even though we all know that inflation is higher than 2.7%. Okay, so looking at July specifically, food was flat, food at home. That's interesting. We actually had a decline there, which tells me that the demand at restaurants might be going down, so they're dropping prices. Maybe that's it. Another big decline here overall was energy, but that was really about, trying to line it up here, energy, commodities, gasoline, fuel oil is where we actually had an increase. That's weird how you had a discrepancy there. Then other energy down. Then we get down to new vehicles. Look at this. Zero. Now, this is something I totally got wrong. If you would have told me that Trump was going to put a 10% tariff on, or whatever it is, on Japan, and that and as far as Toyotas, and I guess that might be too specific because the cost of other vehicles may be coming down. But I would have thought, he's got so many tariffs, although they're very difficult to monitor. I mean, I do these videos every single day, and I have no idea where we are with the Japanese tariffs. I have no idea where we are with the Canadian tariffs, quite frankly. because we have so many categories of tariffs and they change so rapidly that I don't know. I mean, you guys might know better. I mean, do we still have the tariffs on all the Fords and Chevys and everything manufactured in Mexico and Canada? I would assume we do, but it's very difficult to tell, and I don't know the actual rate. But the bottom line is we are not seeing an increase in new vehicles, which I thought we would have for sure. Now we're seeing a bump in used vehicles, but that might be kind of just a whipsaw. Look at last month; they were down quite substantially. This month they're up. Um, yeah, I don't know if there's a lot to read into that number. I would be more focused on the new cars. Another thing too, maybe, and I'm just throwing this out there. I don't really understand the car business too much, but maybe they're selling off inventory they that was on the lot prior to the tariffs. I don't know. I don't know. We get down to shelter in order to point two, but we got transportation and medical services. Those added quite a bit here at point eight. So that's how the numbers kind of break down. I don't know that the market really trades on the details. I think it's more so trading on this headline staying rather benign based on expectations. And then what we're seeing here month over month. And then you combine that with the revisions with the labor market, and I think that's why growth and inflation expectations are really plummeting, and that's why interest rates are doing the same. Let's go over gold. I'm very curious. I haven't looked at this today. We got more tariffs. Okay. Let me just go to the home page. Okay, we got Goldman Sachs. Stand by the call that consumers will bear the brunt of the tariffs. I don't know. I mean, I'm not seeing it in the data. It makes sense, Goldman, but I mean, show me where you're seeing that in the data. Maybe I'll have to read this after I get back from lunch, and maybe that would be worth doing another video on that. But don't want to get too sidetracked. Bottom line here, gold is 3,400. But we have had we've started to see this catch up trade. In fact, I just got done talking to Rick Rule. And every time I talk to Rick Rule, I get really bullish on the gold miners. So again, I should probably save that for a separate video. But gold up slightly. Crypto, so Bitcoin up to 121. That's good. I bought a lot more the other day. Up to 120. I think that's probably interest rates expectations going down, and that's going to benefit some of the more risk on plays, which whether we like it or not, Bitcoin still is. We go to so what's the net? But the Nasdaq is down. Huh. That's really weird. I'm gonna have to think that one through. Here's the biggie: oil. This goes back to growth and inflation expectations. We are seeing oil, and look at this trend, guys. And when you look at this trend, understanding that energy is the economy, and why is this not working? Okay. When you understand that energy is the economy, and therefore oil prices are a very good indication as to the demand side. Now, there are supply side considerations, but the supply side really hasn't been, we haven't really been overly supplied, based on historic standards. So I think this story that we're seeing this trend, I mean, look at this trend. That is a downward trend right there. And I think that's all about demand. All about demand. And I think that plays right into what we're seeing with the labor market, with non-farm payrolls. And this, again, going back to growth and inflation expectations, why rates are going down and why you see CME projecting 100%. And by the way, guys, like I know I said earlier that my base case is probably a 25 cut, but I think the odds are probably 10% they do 50. And if we do start to see the data declining over the next month, I would not be surprised if this 50 goes even higher. And what would that do to interest rates, especially the 2-year? That would make it go down even further, because that 50 basis point cut is not really being baked into the cake right now. That's not really priced into the 2-year. So if this does go up to 10 or whatever, I would expect that bull steepener to get even more dramatic. Now, I was talking to Rick Rule about gold, and I was talking to him about Battle Bank, which is really interesting. They haven't really opened up yet, and I can't wait till they do. He said they're going to have an affiliate program, which I would love to get involved with, because not only am I good friends with Rick, I really trust him. He's a straight shooter, great guy, extremely competent, but I love what they're doing over at Battle Bank. And one of the things they're doing is allowing you to borrow against your gold and use that as collateral. But that brings me to what I wanted to talk about as far as today's sponsor and the guys that have been sponsoring last couple months here. And it's all about storing gold. And this is Monetary Metals, of course, my buddy Keith Weiner over there. And the problem with gold going up in price is your storage fees go up. So what I tried to do is find a solution to this. I'm always trying to figure out ways to make more money, obviously, as a astute investor. And they offer a great solution from the standpoint of they pay you an interest rate on your gold, and it's paid in gold. Now you say, how do they do this? The majority of what they do is called gold leasing. And if you don't know what that is, use ChatGPT, look it up. Once you understand it, you're like, oh, okay, I get it. I understand why a jeweler would want to lease gold as opposed to buying it. But that's how they pay you a yield on the gold. And in a world where gold is going up in price, and most likely, in my view, going to continue to go up in price, you want to try to avoid those storage fees to the best of your ability. And Monetary Metals not only allows you to do that, but again, pays you an interest rate that's actually paid in gold. So if you want to figure out the business model a little bit more, I'll have Josh put an explainer video or a link to an explainer video in the description. Or if you want to check it out, you just give them a call. You go to their website, which is right here, and their phone number is right there. They're in Scottsdale. Just tell them, George, you heard it on a Rebel Capitalist video and you've got some questions, and you can see if it's right for you. Before pitching them, I wanted to set up an account myself. And I told Keith this, and I actually told Dixon, this guy right here. I've talked to him several times. But I said, hey, guys, if I'm going to pitch this on the channel, I want to set up my own account, because, I only want to pitch something that I think is good, that I believe in, and that I've had a good experience with. So I set up an account with them. Right now, it's got about 45,000 in gold, maybe 50, depending on where the price is. And quite honestly, it's been great. It's very easy when you log in. It's simple. You can choose which lease programs you want to participate in and which lease programs you don't. And if you don't want to participate in a lease program, you don't have to participate in one. Now, you're not going to earn the money in the gold, but it's you have total control over it. So if you think it's something that might be a fit for you, check them out. You can go to the website, monetary-metals.com/gammon. And Josh will put a link in the description, or just give them a call and they'll be happy to answer any of your questions. It's something I'm doing for my own portfolio. And as I acquire more gold, my plan moving forward, it's not to put 100% of my gold over there, but for me, about 20%. So as I acquire or accumulate more gold, I think the game plan is to put about 20% with Monetary Metals. And that kind of hedges out the rest of my storage costs. So anyway, that's what I'm doing. Check them out. On that bombshell, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.